The US Federal Reserve has lowered interest rates for the first time this year. It cut rates by 25 basis points, setting the benchmark range between 4 and 4.25%.
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. While the unemployment rate remains low, it has edged up. Job gains have slowed, and downside risks to employment have risen. At the same time, inflation has risen recently and remains somewhat elevated. In support of our goals, and in light of the shift in the balance of risks, today the Federal Open Market Committee decided to lower our policy interest rate by a quarter percentage point. We also decided to continue to reduce our securities holdings.
And that's not all. 2 more cuts could be on the cards before the year is out. So why this move and why now? The US labor market is cooling. Job creation has slowed and unemployment has crept up to 4.3%. That's the highest in 4 years. At the same time, inflation is still running above the Fed's 2% target. That means policymakers are walking a tightrope, protecting jobs without letting prices spiral. Besides, this decision wasn't unanimous. It passed with an 11-1 vote. The lone dissenter was the new Fed Governor Stephen Miran, who wanted a sharper 50 basis point cut. And here is where politics comes in. Miran's appointment reflects the growing influence of President Donald Trump, who has been openly pushing the Fed to slash rates more aggressively. But Fed Chair Jerome Powell framed this as risk management, aimed at cushioning the economy against further weakness rather than responding to an outright crisis. Powell also insisted that the Fed is independent, even as political pressure has intensified in recent months. Trump has repeatedly criticized Powell for being too cautious, while his attempt to remove Governor Lisa Cook has also ignited a legal battle. Also, Miran's quick elevation fueled that debate. Now, how did markets take it? With a lot of uncertainty. Wall Street wobbled, swinging between gains and losses. Treasury yields were also mixed. Analysts say more cuts may improve liquidity, but they warn that political noise and tariff-driven inflation risks aren't going away anytime soon. So what does this mean for India? Analysts say lower US yields often push global investors toward emerging markets. Well, that's good news for Indian equities. A softened dollar also helps the rupee hold steady and keeps import costs in check. In the short run, sectors like IT and metals could see a lift, but in the long run, it will be India's own GDP growth and corporate earnings that truly drive the market. Stay tuned with Business Standard for more updates on how global policy decisions shape markets closer to home.
Want access to Business Standard's premium insights? Join our exclusive LinkedIn communities and connect with top voices in the BFSI space on topics that matter to you.